The tariff madness continues. This morning we saw the White House walk back some of the aggression on the China trade war, with Bessent specifically being quoted as saying this is unsustainable. And now post-market, even more tariff adjustments are taking place during the Trump press conference, with Trump reinforcing 145% tariffs on China, and that if a deal doesn't happen with China, then, quote, that's fine. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan with respect to the wild flip-flop happening in this market. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight on the SPY daily time frame chart, and let's keep it simple. Let's go back to our roots. What is the trend of the daily time frame? Well, certainly, I would argue that the market's trying to produce lows, and it's trying to produce higher lows in this zone. The trouble is that we had the top end of the do or die zone break on the 90-day pause, and ever since then, we've technically been producing equal highs or slightly lower highs. And for that reason, I'm going to start dubbing this zone right here the tariff zone, if you will, the tariff balance, the godforsaken range 3.0 at this point. And what this means ultimately is that if we're in this box, I don't think that the market has made up its mind about what it thinks is the next step in terms of the tariffs moving forward and where market participants are willing to commit capital. If we can see a breakout over the highs of this do or die zone, it's a new sort of zone that we're using up here. It's between 544 as the equal highs from 1, 2, and 3 tests over here, and of course the 550 weekly lower high threat. For anybody not familiar with the weekly lower high threat, let's quickly go there and talk about this. On the weekly time frame chart, the trend of course remains in the downward direction. You can see that we have highs, we have lower highs, and it's very possible that this previous lower wick, what was once acting as support, can now act as resistance, and that is the weekly lower high threat, right? The trend is down, and we're technically making a move from the lowest low in the weekly trend count. One of the things that we've acknowledged is that because the range here is so large, it is technically possible that a weekly higher low could emerge at the same exact time, and we would fall into range compression or trend compression on the weekly. We're not there yet, and it's still too premature to call whether or not this will act as an official weekly higher low, but this reinforces the idea that 550 is still a major threat overhead. If we reset this back down to the daily time frame chart and zoom in, we can start to see how that is so important because it represents the market's most euphoric moment when the 90-day pause was announced. You would think if there are going to be some walkback, some softening on the China stance here, the trade war stance, you would think a euphoric market would be able to break out over that high, and that simply has not been the case as of right now. Once again, Trump post-market, literally just minutes ago, announced or reinstated that, hey, the 145% tariff on China has not gone anywhere, and it's okay if we don't get a trade deal done. We'll just do things here domestically, right? So in terms of that MFU scale, let's draw it out here just to go over it again. Max fear over on the left-hand side. Complacency is somewhere in the middle, and over on the right-hand side, we of course have our little e and big U for euphoria. I would say that the market has moved towards complacency. It's no longer towards max fear, but if you're going to start calling for euphoric starts of rallies and oh my goodness, this is ultimately the low, I think the market's waiting for some news that gets us closer to a euphoric move in the upward direction. Once again, most importantly, getting through the weekly lower high threat at 550. So let's bring this all back to the technicals of what's taking place right now. Obviously, the market gapped up on today's session, and the emergency meeting from Monday, we will fully acknowledge, happened right at the lows of this move, which is why we're starting to consider this an ultimate range, right? You can see that we made an equal low to the Thursday low from this, the day after the 90-day pause. We've made that equal low, and now we're in a balance. So inside of this balance range, the do or die zone, the original one in here, can still play a key role because it does act as previous resistance, tried to hold for support, no longer there. It's still a key level, but it's much more so the midpoint of the tariff range at this point. So if we can hold a daily higher low over 523.75, that would certainly be impressive, but I'm going to lean into what I was talking about both on Saturday's update video as well as the Monday emergency meeting. It is possible, and if I take this down to an hourly time frame chart, we can see this too. right? We did start to get this as a reversal, and we did break out via the gap up this morning over the neckline, but intraday, the market faded all day. So where would I start to say, okay, I'm a bit more confident that the bottom is starting to take shape, the flip-flopping's coming to an end, and we're out of the tariff range? Well, of course, it's the tariff range highs. It's avoiding the threat of that weekly lower high up against 550. So if this double bottom is then going to turn into, ultimately, a daily higher low double bottom that looks like this and this, then your neckline now needs to break up around that 548. That's the bottom of this gap from over here, and we need to clear the weekly lower high threat at 550. If we're just fading back and forth in this range, then technically, as we've described thus far, we're really dealing with a neutral trend. We have huge whipsaws both to the upside, to the downside, to the upside, to the downside, right? We could play this game all day long, all week long. So the next most constructive thing, if we're trying to get back towards like technicals, what's the pathing look like here going forward? Well, first of all, the market faded some of the gap, but not all of the gap. The technical indication there would just be that stronger sellers, in theory, should have closed this gap with no problems intraday. I don't know if I fully believe that it should have been with no problems. In theory, a technical gap should close same day. However, the gap was so substantial in size that a partial gap fill doesn't strike me as being unreasonable. And you can also see here that post-market, now that the Trump announcements have taken place about China in particular, we're actually trading right at 535, so right towards the lows of today's session. And it wouldn't seem unreasonable that if foreign markets open up overnight and sort of hear the reiteration of the China news, it wouldn't seem crazy that the market backs off and sort of unwinds some of the positive news, which was Bessent saying that, it's going to take many countries coming together to make America great. He can be quoted saying that. Bessent was also saying that this was unsustainable, right? That's getting walked back based on the reiteration from Trump just now on the tariffs themselves, and that if no deal takes place, then that's fine also. So the market undoing that doesn't seem unreasonable to close the gap into 530. Now, as a technical trader, I of course would be looking for a possible gap fill reversal intraday on the Thursday session. Something that sets up like this could be very interesting. Could also be interesting to, if we see a pop first and then see a lower high underneath today's low of day, tomorrow, of course, that would be previous low of day, to move into the gap. It's possible that there's a short trade that we can pull off in here for risk reward along those lines. Now, you're probably going to have to be quick draw McGraw for that. And then if you balloon runners beyond that, so that might look something that looks like this, target the gap close. If you can get runners to go beyond that on the short side, I would be open-minded to an attempt for lows, higher lows, equal lows, right? This sort of destroyed the bullish base case that buyers were trying to step up over this previous historic area, right? So the equal low puts us in the tariff range, as we've described, but if we do start to emerge with a higher low, then it starts to put the pressure on which side of the trade, the short side of the trade. And anybody who's short may not feel as confident, right? Especially anybody who shorted the lowest low of the move on Monday. That was a pretty painful location to get involved on the short side, and if you start to see buyers stepping up in here, any shorts who are still holding may have the potential to squeeze back out towards the top end of the tariff range. Now, let's be very clear, even if this higher low does persist, maybe there's a long trade to be taken off of 523.75, I would reiterate what I just said moments ago, which was to really become more confident that the daily double bottom, this here, is going to hold for a firm structural trend change. I know that was the thesis from Saturday. We blew it out of the water on Monday, right? So for that to take hold now, you would need to see some sort of higher high over. Primarily, it's the weekly lower high threat, but then it's the 90-day pause, euphoric market rally where everything went berserk, right? If you can get over that, and if you can start to see price acceptance over that, then I would think, okay, the market's probably coming to terms with some resolution to the trade war, of course, and potentially investors are feeling more confident coming back into the U.S. Another thing that this has to do with, of course, is that overnight, there were also some comments from Trump that said, no, I'm not explicitly looking to fire Powell, but I do think that he is, number one, too late. He called him a major loser. And number three, reiterated just moments ago in the press conference at the White House, Trump said, no, we're not looking to fire him, but we do want rates to come down. Generally, if we can get some stability on comments around the Fed and we cannot get politics intertwined with the Fed, and again, doesn't matter how you feel about what's happened so far, where you think things are going, cannot intertwine the Fed with politics. It needs to remain independent. Otherwise, you just get ready for hyperinflation. If the market gets some clarity on that, it's another reason as to alleviate some of the uncertainty around investing in America, right? If Donald Trump has the ability to just say, nope, I don't like this Fed chair, he's not doing what I think he should do, that is really not an environment that people want to deploy capital in when, political motivations can dictate what's happening with monetary policy. So anyhow, not to go too deep down that rabbit hole, those things are some possible reasons as to why the market may see some movement towards this 550. It would require resolution on the trade war as well as confidence from the Fed. Until either of those two things happen, I think trading in this tariff range really requires a nimble stance and not being overcommitted, I should say, to either side of the potential trade. I think I was, and in all fairness, right, and I see it in the comments section, I got thick enough skin, it's okay, probably overcommitted on the long bull thesis here to rile up some feathers on the Saturday update video, and then immediately flip-flopping to the bear case on the breakdown from Monday. That's classic. But in this zone, right, I think trading the levels and waiting for confirmation out of the daily double bottom low at this point, or if we are going to have to change to become more bearish as we walk forward, breaking these lows is obviously the next indication that would need to follow. That's at 509.75, the equal lows in the hourly range that we're dealing with thus far. So that's what I've got for you in terms of the technical picture. Once again, it wouldn't be unreasonable if the market tries to unwind some of the positivity that we heard today about the trade stuff because of the comments made after hours. If we do get down into the 523.75, 521 zone, I'll be open-minded for a potential higher low. It is possible that it could still take place. Lows, equal lows, potential higher lows, but I'm not overcommitted to that potential stance. You'll also note that that's just the midpoint of a balance range, and you really don't have much of an edge operating at the midpoint of a balance range. Your edge quite literally exists at the upper and lower edges, where you have the opportunity for breakdown or mean reversion, some sort of breakout or mean reversion, and you can manage risk up against those levels. So we'll be on the lookout for that, but not overcommitted. And if we are going to have to change our tone to saying, okay, we're open-minded to what happens at the bottom end of the range, of course, it just comes from a lower high underneath 523.75. Once again, in terms of analyzing what's taken place on today's session with the lack of full gap close, I think it's the magnitude of the gap that matters most. I think the other thing that you're seeing here, and let's walk this back a little bit, is one of the things you're seeing here on today's session in particular, with the good news and some of the positive comments from Besant early on in the session outside of this sort of walking back from Trump, you started to see a market that was struggling near the highs. You didn't really see euphoric continuation as you came into these highs. Instead, the market slowed down, and I can show you this on like a 5-minute time frame chart, right? You can see as we started to run into that area, that's where we struggled, and of course the fade was on after that. So in my view, it's that buyers were not really ready to commit there at those upper levels, the equal high basically to the Wednesday high from the 90-day pause in the first place. So if we just boil this back down to auction theory, you don't have new buyers who are willing to step up here, and you don't have the market will top when the final buyer buys, and the market will bottom when the final seller sells. Up here, there were no new buyers to continue fueling the auction in the upward direction, right? So that lack of commitment, even on good news, would indicate to me that, again, it's not unreasonable for this gap to close to the downside and then possibly keep an open mind at the midpoint of the range. So that's a lot of words to basically say in this range, we want to be very patient. We don't want to get overcommitted towards the midpoint. We'll keep an open mind to a higher low. And if we rotate back up towards the highs, we'll count that higher low in the trend count. It'll be more open-minded to something that looks like this into the future. If we fail that midpoint and produce a lower high, then in here, we would start to keep an open mind to the downside as well. Let's go ahead and drop in our anchored VWAPs intraday. And what you can see is maybe supportive more so of the bull case, right? You had this nasty overshoot, sorry for the zoom there from Thinkorswim, nasty overshoot on the Monday panic day where everything was like, whoa, what's going on here? And then immediately recaptured the low anchored VWAP band from the Monday capitulation gap down from 3 weeks ago at this point. So the immediate recapture to me starts to signal a little bit more uncertainty than just outright bearish activity, right? If the bears were really going to step in here, it should have been, and we can play this card too, if the bears were going to run away with this to the downside, it should have been here on Tuesday, a lower high up against what we were dubbing the do or die zone for a rollover back down to the equal low, Brigade bolt underneath, and then sayonara, bring in a new round of max fear to the downside. That simply didn't take place. So do we want to overextend ourselves? Do we want to overcommit, once again, to the bull or bear side in the midpoint of the range towards the cluster of the anchored VWAPs? I would think not. On the first test coming in, this is the all-time high anchored view app, by the way, up here. On the first test, gap fill reversal could be interesting. Also, the neckline retest of the inverted head and shoulders off of 530, and we'll keep that as a primary card to play for the Thursday session. But any sort of movement through that, we'll just be very, very cautious towards this 523.75. Being willing to go either way in this market has proven to be prudent as a trader. You need to be open-minded in this range, and perhaps myself getting a little bit overcommitted for the sake of the video on the Saturday update, which I know is going to ruffle some feathers. So that is what it is, right? Let's get on over to our market internals and take a quick interpretation of what's happening from this point of view. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. You can see here that on the Tuesday flip-flop, so Monday, in the emergency meeting, right, we acknowledged all of these big bearish readings out of the market internals, really, really bearish on the index score intraday. You almost had the polar opposite on the Tuesday session. Not that it unwinds what happened on Monday, but strong volume inflows, clearly up and over 300 million. You had an advanced decline line up in trend higher zone or above, index score that was strong, and a cumulative build nice and strong in the upward direction as well. So to look at it just day by day here, I would say that this is more of an indication of volatility and overcommitment, which causes the whipsaw in the market. So I think a really important concept to pull out of the market internals here is that as we pulled back today, you could see this from the volume flows. As the pullback was taking place, technically we still had positive volume inflows across the exchange. It's not like many things were underneath previous day's settlement. You can see that we're still up here in trend higher zone. The index score flipped to negative, which is fine as we moved underneath the opening print and the opening range, really, out of the S&P 500, but the cumulative build was fairly flat. And what that would start to indicate to me is more so a rotation that's taking place here, which ties perhaps nicely into a comment of remaining neutral in this range here. For anybody who follows the theory of a follow-through day to figure out when a market bottom is potentially taking place, it's the first up day that has more volume than a down day preceding, right? And there's more specifications than that. Don't call me out on the exact rules in there. But Tuesday could have been seen as a follow-through day to the upside. Now, what you don't want to see after that is any stronger volume on a down day that follows, right? And you can see here that as we gap up, the volume is actually higher than the previous day. And all that starts to indicate is it's very possible that this is more so distribution towards the highs rather than sustained accumulation and some sort of new trend that's going to be able to develop here. So when we circle back to the market internals, I think that that starts to confirm a little bit of that indication where when the market was down technically, you still had a lot of volume flow. You were over-correlated to some degree up here, and the cumulative tick was quite flat, right? Not really indicating that you had sustained market momentum in the upward direction, and that distribution could easily be what's taking place there as people are selling into that gap up as we're headed towards resistance, right? Let's jump on over to our market profile and take another look at what's happening over here. If you're not familiar with the profile, check out the video tutorial in the top right-hand corner. Generally speaking, really poor highs straight across the top and bottom. Value did progress higher, obviously, on the gap, not closing today. However, you can see from here to here, but relative to the individual session, the value area was lower. The point of control was certainly lower. And again, poor high, poor low would indicate that the auction did not end properly at either side of the market here today. So any tests, let's say that we open in range, right? Any tests of the previous day's low tomorrow should indicate a move through that on the first go around. And the target here becomes quite clear into the full gap close. If I just go back over to our good friend, the Spider's Cash, and let's go back on over, let's go to an hourly chart reset though on the intraday here so I can go over the pathing one final time because, this stuff to me is, there's a lot going on. There's a lot of moving parts to this market. I think ultimately the open mind theory is going to serve us best, but some potential pathing ideas. We open in range, right? We open in range, lower high gets set, Brigade bolt underneath previous day's low, look to close the gap. A trade to 530 makes a lot of sense. Reevaluate when we get there, considering that it's the retest of the neckline from the inverted head and shoulders. If we go beyond that, it's the midpoint of the range, and once again, it's very possible. I would keep an open mind, and one of the cards I'd be looking to play, as we said earlier, is this higher low, in theory, out of the hourly attempted trend count, right? Something that does support the midpoint of the range, although maybe not giving you the best edge on the daily. I would start to at least try to take a trade in here to move back in the upward direction towards some of these levels, 530, depending on what the reaction looked like back here, and then ballooning that runner, if we can, up towards the top end of the range. If this does set a higher low, it increases the odds that we would break out through this over the span of time. Another higher low here would be great as well. The more higher lows you can put in relative to that 544 equal high, the stronger the chances, the higher the probability that the market should attempt a breakout there, right? If we do see a failure of this 523.75, this is where we're really neutral, right? So something that opens in range, does everything that we've talked about so far, consolidates and bear flags underneath. This is, I'm not going to call it an easy trade, but it should be easier in theory relative to the amount of structure that we actually have at these levels, right? The market was fairly straight down through this and tried to get a little bit of a pop into the close there. If we can get a lower high underneath this zone, again, I'm not saying that it's easy. It is easier rather than battling through a thick area of consolidation or congestion, so to speak. So underneath 521, 523.75 with a lower high, targeting 509.75. The worst thing that this market could experience would be some sort of just, straight up flush straight to the bottom of the range and then a Brigade bolt underneath, retargeting these equal lows. If that takes place, weekly bull flag has the potential to break down and, of course, continue this market move in the downward direction. I would say as of right now, it seems as though to some degree the market has priced in, and everybody is very well familiar right now. I know we're talking quite a bit about the S&P, but everybody's very familiar about the trade war that's happening, the uncertainty. I mean, you can see the sentiment online. You're getting strong calls for this is the bottom, this isn't the bottom. The market's going to be like a Black Monday next week, and oh my God, everything's going to go to zero. I think the market has digested that there's a ton of volatility out there, even if the VIX is coming down a little bit. And the VIX actually coming down a little bit is sort of an indication that the market is coming to terms with the amount of flip-flopping that the market, policy, I should say, is undergoing. So to me, I would say if we were to get underneath 509.75, I would watch the VIX very closely. It would take a new catalyst, something new, different, and extreme to drive prices underneath this shelf down here at 493.25. So am I still, big recap here, just to summarize, am I still of the belief that some sort of structural higher low could potentially be in? Absolutely. I think that max fear has mostly been reached from a news headline perspective. It's just a matter of whether or not market participants are willing to auction the market higher up and over 544 at this point to do two things. And we didn't really talk about this on the daily time frame chart. I'll show you this trend line in just a second. A lot of people are talking about it, I'm sure. But this as a double bottom confirms over the neckline, 544. And also on the daily time frame, if we bring out this resistance trend line from the high to look something like that, all-time high, lower high, until that breaks, some people, I'm not a big fan of trend lines, I much prefer horizontal levels, but some people might say that the downtrend isn't over until that actually breaks. Well, lo and behold, it does happen to align with our horizontal level as well. So if that does come into play, that's where we change our tone and definitively say with more confidence, okay, double bottom neckline has been breached, we're over it, and at this point, we would be looking for positive outcomes walking forward. If we remain in the range, anything sort of goes in the tariff range. We've gone through the S&Ps. Let's quickly round up the QQQ NASDAQ 100. Let's see what's going on here from a trendline perspective. Since we're on the topic of trend lines, let's check in with that. You can see that the upper wick here certainly punctures the trend line, but we've closed underneath technically. I would argue that the QQQ has a tariff range as well, something along these lines here. Let's take a look at the hourly time scale. Zoom in a little bit and walk through it. So a lot of the comments, a lot of the theory, a lot of the concepts are the same here in the QQQ. You're just dealing with slightly different numbers, right? So we'll move a little bit quicker through the Qs for that reason. If this is your magic inverted head and shoulders that's going to cause the big move in the upward direction, then you would want to see a gap fill reversal off of the neckline that's 477.25. As we said, it wouldn't be unreasonable to open in range, set some sort of lower high underneath the prior day's low, close the gap. When we get here, you can reevaluate. If the market does move lower out of the QQQ, let's just say it looks something that looks like this, and we get to this zone, this just like the S&P 500, probably less important. I would be a little bit more inclined to use something around this level down here, somewhere around 432.50 would be a number that I would update to have on your screens, 432.50. We're doing it here together. Let's drop in 432.50. Not a big fan of cherry picking the wicks, but I do believe with the settlement from the Monday session that also holds some import there. So we can throw that one on, and if we do move underneath the do or die zone, which is still labeled in orange, we would be looking for that to come in as the bottom end of the range, right? In which case, risk reward might tell you that, okay, something along these lines could be in play. You could try to, and not that I would recommend this as a trading strategy, certainly not. I would always rely on the technicals, but it seems as though we're getting some sort of positive tariff intervention whenever the Qs come down towards this zone around 430. Again, this is not a trading strategy, just sort of giving you an observation here. Whenever the S&P comes down towards this 510, it seems as though there's some sort of positive intervention on the tariff front, and the market sort of, likes that. And then up here, seems as though there's a little bit more aggression in terms of saying, nope, we're going to stay I shouldn't say level-headed. I should say firm in our stance against China. So do with that what you will, but play ping pong in the range, and that's fine. QQQ, let's check in on those anchored view apps, see if we're dealing with the same thing. And you could make the same argument, right? If this ultimately is going to be a higher low double bottom on daily, you would need to break out up and over your weekly lower high threat, which is the neckline, at 465.85. Watching that very closely. Any consolidation up here, let's just say that we open in range and do something that looks like this. I mean, to me, it's consolidation towards the top end of the range being this box right here. In theory, it's higher lows, and that would increase, as we've said in the S&P 500, the likelihood that some sort of Brigade bolt up and over the top end at 465.85 can get follow through in the upward direction to confidently change the trend a little bit more so, right? The other thing that a lot of people are observing, and specifically on the NASDAQ here, if you go to a clean chart, you can see it very, very cleanly. You're getting something that, or at least was, looking like range compression along these lines, an attempted breakout if you're coming from this high. If you're coming from the all-time high, not so much, right? We just saw that on this trend line right about in here. We closed slightly underneath on the hourly time scale. Okay, so that is the QQQ. Those are the levels. We just walked through them. Keeping an open mind between 465.85 and really down here at 432.50, the work that we just did. Let's throw on our anchored view app set, see what's happening from this point of view. Once again, put yourself in the shoes of a seller. On the Tuesday open, you would have liked to see a rejection up against 441. Did that take place? The answer is absolutely not. It didn't take place, so that neutralizes things in the anchored view app band. Now, they were over a cluster of the anchored view app band, this again being the all-time high anchored view app band. But because we're over this, the gap fill reversal suddenly doesn't seem that crazy, right? This is the 90-day pause announcement, and of course, this is the Monday acceleration to the downside, if you will. Anybody who's short in the hole and trapped down here, right, they're still underwater, even if we pull back to test the neckline of, once again, the inverted head and shoulders that we've just talked about at 447.25. So to me, I really think that a pullback can unwind some of the progress that was seemingly made overnight here, given some of the most recent comments. We'll see what happens overnight in foreign markets and even before the market opens tomorrow. It's just a game of sort of wait and see in this current environment. But if you're really looking for the final solution, the answer that just says, like, what's it going to be? I would say bulls probably need to wait until there's something more concrete over the 465, and bears, you would need to break down underneath 432.50 and revisit these lows if I'm going to get worried more so about another threat of a down leg here. That's the QQQ. We can take a look at the NASDAQ internals. We'll keep it brief over here. Spent quite a bit of time rambling on this market considering all of the flip-flopping that's been going on. I think trying to take a level-headed approach and remaining open-minded in that range is probably the best approach going forward. We've got ourselves solid volume inflows on the Tuesday-Wednesday session above trend higher zone out of the advanced decliner. So once again, what does this mean? It's probably over-correlated to the upside. Wouldn't be shocking to see a little bit of a move to the downside to correct some of that. This, again, is an indication of volatility. One day it's sell everything, the next day it's buy everything. You need a rotational market that's got some in-between if you're going to sustain a move, right? In terms of the the cumulative build out of the tick, positive on Tuesday, not quite as strong as the S&P, and pretty flat today out of the Wednesday session on the fade off the highs. Once again, you could make the same arguments from a volume perspective on the daily time frame chart here, with the increase on the up day being a follow-through day, and then on today's session, this acting more so as distribution. Same argument as the S&P from a volume perspective if you're into that type of thing. Let's take a look at the NQ futures to evaluate the point of control here. It's actually higher in the overall profile out of the NASDAQ side of the market. I find that a little bit more so interesting. You also don't have as extreme of a poor low, probably lacks material excess here considering the range of the market. Yeah, only two TPOs, which is hardly two when you're dealing with a 20-point y-axis. But lack of material excess. I wouldn't really call this, a big bang where the auction went out on the proper footing versus something like your A period here. That's proper. This is proper excess at the extremes. Improper excess here and here. Just trying to find you some more examples of what looks proper. This F period looked more like proper excess, right? So that's kind of what we're looking for if we would like to consider something, meaningful excess. We don't have that out of the NQ futures. So I would still treat these as poor and weak levels, meaning that if you were to test them intraday, wouldn't be unreasonable for them to break. And we already talked about the gap close to the downside acting as the first trade thesis to start to implement on the Thursday session. If it is going to be upside, once again, consolidation in range probably doesn't yield very constructive trades. If we just go back to the QQQ, consolidation, same concept in the S&P. Consolidation here probably doesn't yield anything constructive. It would have to be the breach up and over that 465.85 as we've mentioned so far. Let's check in on our good friend, our long lost IWM Russell 2000, the small caps. What do we see over here? Finally, I find this quite interesting. The small caps actually broke out over the high of the 90-day pause. And, it wasn't sustained, and you can see that we closed right back inside of that range, but there was an attempt here. And this is kind of noteworthy considering that small caps never really got in gear like the S&P and the NASDAQ did on the attempted higher lows, to change the capitulation low into a structural higher low earlier on in this phase here, right, where there was a pullback that remained above. You can see that in here, it was much more below. This was overlapping. So out of small caps, I am quite interested in seeing how much, if any, of this gap continues to close and whether or not the market can sustain price action over 190.25. If it can, then I'd really be interested in the tests and seeing what happens at the monthly key zone. If you're trading small caps, then you know better than anybody else that 200, 198, this zone right here is a big, big deal. There's potentially the threat for a monthly lower high there. There's potentially the threat for a weekly lower high at that zone. So I wouldn't say that the small caps are out of the woods here, but you can color me slightly impressed with the attempted break up and over the Wednesday 90-day tariff pause, whereas the other indices, of course, did not do that. As we take a look at the hourly timescale chart, quickly checking in, we've broken out of this as a range. So if you're a bull here out of small caps, you just have to be looking for some sort of gap fill reversal off of 188. If the market can sustain that, some sort of higher low here, it's constructive in the upward direction, I would be not all aboard the long train, but I would certainly be thinking more positively about outcomes for the S&P 500 should the small caps be able to maintain 188 as a potential area for a higher low, right? You have lows, equal lows, somewhat of a higher low happening here, higher low at 188. The hourly trend is trying to be set in the upward direction, right? Breaking out of this range, making a higher high from here to here. So going all the way back to the basics of technical analysis, you could see that higher low would be quite compelling for the trend count. Right, so that is that. In terms of the anchored view app spread, it's right there, and there really wasn't a worse close underneath on the Monday breakdown. There was an overshoot, but we really closed right back at the bottom end of this as a balance range there, so kind of interesting from that point of view. Daily resistance trend line, do we have that in play out of the Rusty Russell? It's probably way off. Yeah, look at this thing, way off. So you could make that argument. You could make this argument that today's upper wick is a rejection of the secondary. I'm not a big fan, but the fact that it does coincide with the weekly threat here does make a little bit more sense to me. Let's check in on the market internals for the Rusty Russell side of things. We can see okay volume inflows, a little bit weaker of an advanced decline line and a cumulative build that was not helpful whatsoever. It seems, again, reasonable that these small caps might try to retest that 188 here in the RTY futures. We've been talking about 920, but previous day's high, aka the gap close, is going to be closer to 1905. 1905 out of the RTY. Let's jump on over quickly to the Russell market profile. Point of control slammed lower on the day's session, not really confirming the gap up. Extremely poor high in need of repair from the Tuesday session, poor low on today's session. All of the same commentary as to what we had in the S&P 500 basically. What you would want to see is if the gap closes, let's say on Thursday the gap closes out of the Russell, does value overlap this or does it remain higher over that 1905 level that we were just talking about? If value can remain higher, that would be much more of a constructive sign that the market's trying to produce some more meaningful reversal in the upward direction. Let's get back on over to the platform here. Let's quickly reset this to our ratios so we're prepared when we have to flip screens. We'll bring this back to the S&P and we'll rip through our sectors here. Who was leading, who was losing, and where is the weight. We've got semiconductors leading the pack here up 5.3%, followed by technology up 4.34%, and then the discretionary sector up 4.15%. Tesla earnings having something to do with that, but more so just the positive comments overnight that led to the gap up in the first place, which is being unwound as of right now based on our conversation so far. At the bottom end of the barrel, the XLP consumer staples, which is risk off, D for defensive, underperforming here on the week, down 21 basis points. Beyond that, the laggards are healthcare. TLT, the bond, the long bond, is lagging as well. And just to get another sector in there, let's go with XLRE real estate, which is a little bit more defensive in nature as well. So posture here, I'm not going to argue that it's full-blown risk on, but it's definitely not risk off, at least in terms of this week's performance, as we're sitting inside of this balance range near the highs of the tariff range, as we've dubbed it so far. Let's jump on into the semiconductors and make note of what's happening here. So a very impressive recovery over our do or die zone, which was 195.15. The gap down on the Monday session was pretty detrimental to that. Tuesday's follow through didn't really get up and over that level. So the fact that the gap up here is above the level is a good first step. But if I'm being honest, it's possible that we go lows, higher lows. Would want to see this hold now. And then where do we really change tone? Well, it's the same thing as the S&P 500. And we even acknowledged this in the Saturday update video, where the markets were sort of caught between a rock and a hard place. The hard place being this, the 90-day pause high, and the hard place, or rock or whatever, what I just said, is at 195.15. If the market can hold up above this, then we're still in that zone. We're doing what I would consider just, quote, okay. And then if we could do this, that's like, okay, full steam ahead. The market's trying to resolve this issue in the upward direction, right? If we just see rejections up against that and we continue to waver up around 211, it becomes a little bit harder to make a compelling argument that new price discovery is showing some signs of improvement, right? We have not seen new price discovery relative to the 90-day pause high. As we take a look at the XLK and see what's going on with the technology sector, a little bit more of a better looking chart here with the lack of overshoot and then hold underneath on the Tuesday session. So Tuesday's follow through up and over the 190.75, a little bit better here. Still going to make the argument that the rock and hard place idea is still in play, and over 206.40 is a good idea to get more confidence about the long case, the bull case for the market. As of right now, today, the inverted hammer, again, like the S&P, it wouldn't seem unreasonable that any sort of, with the walking back of some of the tariff stuff, at least walking back the positive news, becoming a little bit more firm in the stance that no, the 145%, and the if no deal happens, that's fine. It would seem like the gap close could be on the table here, and some sort of test of 190.75 into the end of the week would really set us up for the next idea. If this can hold a higher low technically, maybe it's worth keeping an open mind to better than expected outcomes towards the highs. But as of today's candle structure, not completely sold on the idea that we're ready quite yet to break out through this 206.40. Let's jump on into the XLY. Discretionary. Tesla, yeah, the earnings sort of popped in the upward direction. I would really argue that that was more of the tariff commentary and Jerome Powell commentary rather than the Tesla numbers themselves. If we're looking at the XLY chart, it is, it did move higher. What I like about it is at least there was a test over the 192.75, but now it's all about like no ifs, ands, or buts about it. You would want to see 188 hold here if you wanted to remain constructive on the long side for the XLY discretionary sector to make a recovery effort. If you can't hold that, then you start dealing with much more of that range as we were talking about in the S&P 500. And it becomes a waiting game to figure out, okay, are we going to break the highs or are we going to break the lows? So given today's move, and again, the test that was at least over the weekly threat, I would like to try to keep an open mind to better than expected outcomes here. And maybe that's still that permeable of YouTube in me somewhere trying to break out and say, no, we want this market to go higher. Keep an open mind for further upside, but the close here is certainly not all that compelling. As we look at the XLF, excuse me, XLF, much better here over the top end of what you could consider the higher low double bottom, breaking out of, even on the hourly chart, you could call this like cup and handle, something like that. Doesn't matter what you call it, but if the XLF can sustain price acceptance over 47.60, you're getting that price exploration, that price attempted, it's not acceptance yet. This candle certainly does not suggest acceptance, but you're attempting to find value at a higher price relative to the 90-day pause high, which is meaningful. Also, as we know, if we zoom out here, it's the neckline of this Head and Shoulders, which I'm not going to say it's fully responsible for the breakdown happening here, but it does align nicely from a levels perspective at 47.60. So watching that, if we're above, a little bit more compelling for an open mind, a bullish open mind in the S&P. If we start to break down underneath, neutralizing here, and all hopes and dreams out the window on a lower high under 46.40. Moving into communications, you can see that we've sort of got a recovery over the level, but underneath the hard place, if you will. So open-minded to neutrality here. Really impressed over 95. If we can hold 91, again, maybe keeping an open mind. Communications are a risk-on-ish style sector, so we'll give that the benefit of the doubt at 91. If it fails 91, then as we've said, it's just sort of back into a range here. Let's jump on into industrials. Trying to make a move here, but rejecting the key weekly lower high, so can't quite say anything overly constructive about it, but sustained holds now that there's more room to pull back, basically from an equal, if not slightly higher high, if you want to split hairs with me, slightly higher high. Room for a higher low here at 122.50 to sort of sustain neutral but open-minded on the long side. Through here, we'd really start to be more concerned if these lows start to break at 122.50. Energy, not really liking that energy can't get up and over this hurdle at 82.85, just continuing to signal a little bit more of that recessionary concern coming out of crude here. Global demand for oil not really doing so hot, right? If anything, this looks like a classic Brigade bolt to the downside, which again sparks more of those recession fears more so than anything else. So you'd want to see crude over 64 a barrel and the XLE, as we just saw, over that 82.85 mark. As we move into utilities, most bond-like sector, D for defensive, midpoint of its range, nothing to really talk about there. As we look at materials, rejecting this, so home builders probably not doing well either. Let's check in on that. Have not looked at home builders in a little bit. Yeah, some potential for a lower high here, just in the general trend count. If you were to do something that looks like that, I'm using it as a trend line there, decent confluence towards 95. Generally some issues with the cyclical side of the economy here with home builders sort of rolling over and rejecting, failing to sort of break out more meaningfully up and over the 90-day pause high. As we jump back into the sectors, the XLRE real estate, same concept. If this is a head and shoulders, the retest of your neckline is a beautiful Brigade bolt to the downside. Nasty inverted hammer today. What you would look for here, of course, is a breakdown, and this is just like common across all the bearish setups with a lower high Brigade bolt. Lower breakdown of the lower bound of today's range brings in, continuation to the downside, walk down to your next target. 39 would be something reasonable out of real estate. The bond got hit a little bit today, the long bond here, rolling over from the gap up. What seemed to be constructive on the comments about not wanting to fire Jerome Powell just resulted in, that move basically became, goodness, I'm moving a million miles an hour today, huh? Unwound straight back down to these equal lows, basically. Not really making much progress here on the bond front. I think that this continues to show signs of fear about inflation, and we can get into the logic behind some of that on the PMI prints, which were actually released this morning at 9:45. They don't really look good, right? And you also had conversations, we won't see this in the headlines in today's video, but there were conversations between Trump and the CEOs of, I think it was Target, Home Depot, and I'm going to say Walmart, but I feel like it was a different retailer like that. But all 3 or 4, however many CEOs he met with, cited that the tariff policies are immediately going to drive prices higher. They're already seeing that, and shelves might not, there might be nothing on the shelves, right, by the time that this fully gets wrapped up in the system. So some of the Besant comments, I'm sure, came on the heels of realizing that, again, this is unsustainable. But this afternoon, right after the market closed, right up at 5 o'clock, pretty firm on that 145% tariff stance. And if there's no deal, that is A-OK, according to Trump. So XLV, talking about healthcare now. Back in here, what are we seeing? Midpoint of the range, this is D for defensive. If it does break out, just noting that it's a heavier weight sector, it's probably interesting to keep tabs on, but not really seeing any concrete trade to take here in the midpoint of what is just clearly a volatile range. Then finally, XLP, consumer staples, attempting a higher high breakout, but not really doing anything meaningful with it. I would find that a little bit, I think the structure here is far more bullish than the other charts that we've looked at. Obviously, you've had this V-shaped recovery. It's possible that a higher low here is much more powerful, right back to the all-time highs relative to something like tech. It's just interesting that the weekly performance thus far, it's underperforming, but the technicals chart still looks way better. So I wouldn't rule out, even though this appears to be risk on in terms of posture, I'm not sold on the idea that we're all the way there yet. Is it possible that the XLK could produce a relative higher low? It's possible. We'll keep an open mind to that, but for now, don't want to jump the gun on calling it. The green shoots faded in the first place, so if we can get a higher low, great. But at this point, now that the markets have not run away, you can think of it like this as well. Just to go back to the S&P here and continue to solidify and clarify some thoughts. if the market was really going to go for it and like we would be expecting all-time highs and all of this to be unwound, prices back up here over 550, just over 550, the weekly neckline, it should have been like no looking back. This should have held and should have gone, and it just, clean, blink of an eye, done. If that was the case and we moved over here and we saw these green shoots stick, then like great, we would have been fantastic, bullish base case lives on, and we look for upside trades. The fact that now it's taking more time to resolve, and this is building out maybe as a double bottom like this, there was some overshoot, the market's fading off the top end of the range, the comments are still wishy-washy, we haven't really gotten clarity from the administration on what's happening here. Not that we want to like purely turn into news and macro attempted traders, we're still trading the technical levels in front of us. But as we use the intermarket relationships to maybe bring some sort of idea and thesis to the table, now it's going to require, right? If you didn't just run with it the first time around, it's going to require much more of, okay, let's break the neckline here, let's get a higher low above, and then let's move in the upward direction. XLF looks good. I will say that. XLF does look good here. We saw that the technical chart there looks good as well with the break over the rock and a hard place zone. XLY not quite out of the woods. Again, it attempted higher low, but you need to get a higher high here now. Now that we've sort of gone through this back and forth, need the higher high. If we take a look at the risk off sectors, these still just look like potential higher low pullbacks well above upward sloping 50 SMAs, upward sloping 50 SMAs. If we look at some specialized ratios here, you can see, again, the opportunity for the double bottom, but break the downtrend, and then we're convinced. So you could come in here with a trend line, do something that looks like that. It could happen as soon as tomorrow. I'm not saying that it can't, but we need to see that concrete evidence first and not just a rollover here and the trend to persist in the downward direction. Same comment over here, same comment over here, same comment over here. Honestly, in a weird twist of fate, the ARK K Innovation Fund honestly looks, I'm not going to say good, but it looks better than some of these over here, sustaining a higher low and going on to break sort of this, if you will, as a flat top area of resistance. Kind of interesting. As we take a look at the risk on-off B ratio grid here, gold on the big pullback gap down today, starting to signal maybe a little bit of that blow off top coming in there. So watch out for gold on the pullback. I'm not going to say that, I'm not going to go out on a limb and say that I think gold should collapse here, but a little bit of pullback digestion would seem reasonable after the move that it's made recently. As we take a look at Bitcoin, I think that this is a more compelling story for the risk on side of the market, maybe over 92,000 with a risk on signal coming from the Saylor Schiff ratio as gold pulls back. So money coming out of gold maybe into Bitcoin supports the idea that keeping an open mind to the long side still on the S&P. We're neutral in the range, but keeping an open mind where you could see the reason, we could see some of the arguments behind the long side on a breakout of that range over the neckline there. Bitcoin's possibly playing a little bit of a role in that as gold cools off. As we look at the TLT ratio to the S&P, again, and we've talked about this in the Saturday update videos, we'll see this on credit spreads in a moment as well, we need the lower low. We need the lower low here out of the ratio. After a lower high, it would be a little bit more compelling for the market to continue to move in the upward direction. But as of right now, we just don't have that. It could happen as soon as tomorrow, but we need to make sure that we have that confirmation in hand, perhaps before making a bold call like we did on Saturday. Let's take a look at the dollar here. Dollar catching a little bit of a bid as seemingly it looked like there was some resolution and confidence forming around the Jerome Powell position there. Some dollars coming back to the U.S., money flowing into the system, if you will. The dollar strengthening here a little bit against some of the other currencies. If we just go something like 6E, you can see that they had a pullback here over the last couple of sessions as this news was announced about, no, we're not looking to fire Powell, and we think he should lower rates, but we'll let him be and do his thing, right? So that to me is sort of the narrative of what's happening here. How does it impact equities ultimately? Well, the 10-year and the dollar strengthening to some degree still sort of signals a little bit of that recessionary fear, or excuse me, not recession, my apologies, but rather the, God, I'm blanking for words here as I'm moving a million miles an hour, inflationary fear. So speaking of inflation, let's talk about the inverted ZT here, which has moved in the upward direction. It's not signaling a rate hike, so to speak, but it's certainly signaling that the market is not as worried about maybe an Armageddon style situation. Let's jump over here, deep, dark, dirty recession, but let's combat the inflation side of things. So 94% odds of a pause in the next meeting, which of course is May 7th. We'll stream that live when it takes place. But now we're only air quotes, getting 1, 2, and 3 cuts into the end of 2025, which is down from the 4 cuts that we had prior. And we think about why this is happening. Again, it has to do with all of these signs that inflation could come roaring back if, number one, the Fed cuts too aggressively, but number two, as a result of all of the tariffs that we're seeing enacted, right? As we take a look at the, excuse me, the economic calendar from today's session, services PMIs, it didn't contract in a big way, right? So it's still solid that we're over 50 here on services PMI. But if you actually read what some of the comments were from the reports, and I've just highlighted these for us, on the price front, input cost inflation rose to a 7-month high, driving firms to increase their output charges. Interesting. I wonder if this tariff thing is going to show up in the data in the future. Because everything that you hear from the administration right now is that, oh, we just got 2 CPI reports back to back that showed hardly any inflation, if not disinflation, right? When the reality is that the tariffs, although maybe some people would like to think that as soon as they're in place, like boom, it's going to show up in the data, it's going to have some time to show up in the data. And we know that Jerome Powell said it outright, basically, in some of the conferences he's been at recently, where they're going to be watching very closely to see how the April data comes in, the May data comes in, and of course, that doesn't happen until May, June, July, and then some decisions will start to be made. So lowering rates ahead of some inflation shocks does not seem to be a very wise thing to be calling for here. So with some of the backing off from Trump on Powell, I think that's why things are settling out a little bit the way they are. As we move into manufacturing, you can see the same thing. Input costs rose at a pace not seen since August 2022, driven by tariffs, supply issues, and weaker exchange rates. Wonder where that's coming from. So, regardless of how you feel about the actual policies, you're seeing the disruptions in how the market's trying to handle this and the repricing of the S&P as a result, and the odds of rate cut or not. As we take a look at the earnings calendar, of course, we talked about Tesla on the miss across revenues. Revenues were down like 20% on a quarter-over-quarter basis. I've not looked at anything after the close today. Really not interested in that too much. The big heavy hitters next are going to be Google here, Intel a little bit, Texas Instruments, Lam may be worth digging into at your own time for semiconductor insights. But personally, I'm waiting for that until we hear from the big dogs, AMD, NVIDIA, Taiwan we already got, and some of the others in that cohort. So that's the earnings calendar. Let's get back on over to the platform here, and let's take a look at some of our additional supporting evidence. As we look at bonds relative to themselves, I think the narrative continues to just be screaming in terms of these relationships, right? This breaking out to the upside here, but still in a downtrend, would indicate that there's a preference for the shorter end of the curve. Whereas if you do something that looks like this, you're breaking out through this, and you've already made higher highs relative to the same exact pivot. That is the market saying, whoa, we are worried about what? Of course, that nasty I word, inflation. And we just saw the same thing being reiterated from the PMIs, which came out on today's economic news front, right? Let's jump into credit spreads here. We were talking about the same thing in the TLT, the ratio at least. You would need to see lower lows. We're getting close. Obviously, volatility is subsiding to some degree, but you're not all the way there yet in credit spreads, continuing to just keep us a little bit on edge there. As we look at junk bonds in isolation, they are giving a positive and bullish divergence here. So I'm not going to go out on a limb and say, like, I think the market's going to crash and, oh my God, the flip-flop from Monday is the worst thing in the world. I don't think that the market's in another outright state of panic, but I do think that we are still seeing some interesting indications for the long side to still have a little bit of an edge inside of this balance range here, the tariff range out of the S&P 500. So continuing to try to keep an open mind to, if we do see better than expected outcomes, I don't want to fight the tape on that. I do not want to fight the changing of the tide here and potentially some better than expected indications coming from some of these intermarket relationships. And again, junk bonds outperforming here could be one of those things. If we look at corporate grade LQD in isolation, you could see the same thing here where you've made much more of, I guess it's kind of more similar to the S&P. Yeah, it's the same thing. More of an equal high, whereas the junk bonds have certainly made a higher high. Let's jump on into our good friend, the total breadth. We've already looked at Bitcoin. This is the same chart we were just talking about with the positive firing of the Sailor Shift tool. As we move on into our breadth, though, you can see subtle improvements here out of new highs versus lows, getting up and over into positive territory once again, keeping an open mind to better than expected outcomes, even though we flip-flopped so much on that Monday, Tuesday, announcement, so to speak. As we let's jump into RSP equal weight, still over what I would consider the key level at 161. Why 161, you might ask? Let's go to an hourly chart so you can see it. As we zoom in here, and let's go extended hours off. Oof, boy, it's going to make me go all the way into the settings. Let's unwind that. There we go. You can see here that would have acted as your initial double bottom neckline, over, acted as resistance, over, acted as support, overshoot, support, right? So got to hold 161 out of the RSP. If we're looking at the QQQE, equal weight NASDAQ, it's a similar story where we're backing off of the weekly threat, but still above the 81.25 in this case, as the key level to hold down below this would be your tariff range out of equal weight NASDAQ. A breakout over 86 would be really compelling for a stronger bull case to be made in the market. As we take a look at volatility, let's jump into the VIX, overshot it there on the click. VIX is making a slightly lower low on the gap up this morning, but I would just sort of ask the question, if this was ready to rock and roll in the upward direction, and literally when I draw the arrow, I'm not saying towards all-time highs, but if it was a stronger move to neutralize the threat of the weekly lower high, you probably would have seen the VIX collapse on today's session via the gap up, especially during that morning rally. VIX should have been floored down towards like the 22 handle, something in here, the origin before all this madness took place, and it just didn't happen. You could see similar indication here out of the VVIX as we rotate to the downside, but where did we close? We closed higher on the session, right? And VVIX underneath something like 103, we have that level mapped for a reason. Underneath 103 starts to get a little bit more comfortable out of the VVIX. If we take a look at the volatility futures here, are they in backwardation? Still, the answer is yes. This is a more mild backwardation, absolutely, but we are not out of the woods yet. As we take a look at the VIX 1D, also no new lower low out of the VIX 1 day. So once again, is it all clear? Is it let's rock and roll to the upside and just nonstop new all-time highs? No, but I do think that the buyers have a small edge still in the balance range, and perhaps that's just the permeable of YouTube coming out once again. Let's jump into the core list of companies, and then I've got those two trade ideas for you. We'll keep it brief through here just because a lot of these ideas are going to be rinse and repeat of similar concepts, right? So NVIDIA underneath 104.75 is technically a danger zone, and honestly, the permeable of YouTube gets a little bit more neutral as I look at some of these indications, noting that these are the heavyweight components of the S&P, right? NVIDIA underneath 104.75 is not a good look. And you would say something similar, obviously, with the SMH underneath its key level. Any consolidation below 104.75, let's take a look at the hourly time scale, is not really a confident break of this as like inverted head and shoulders. You would have to be over that level. So consolidation in the zone that offers a gap close tomorrow could be a very interesting and lucrative trade into $100 flat. I would certainly reevaluate at 100 for multiple reasons, not only just the 2-day high from back here and previous lows from there, but also just a round psychological number. If there's going to be a move to the upside, I would really be not even interested in the long here. I would be firstly, okay, this is getting me interested, but not in the long yet, but this is the long trade I would look to take. If I could manage risk through this gap overhead. I know it looks funky with this previous low, but the gap is technically to the 930 low of this day back over here. That was Tuesday of last week, right? So those are your key levels out of NVIDIA. Let's talk about Microsoft. I'm going to leave it on the hourly time scale, but zoom out like this so we can just see these previous lows at 377.25. That's your threat. The fact that you're rejecting that so far on today's session doesn't really build a strong case for the buyers here to be flexing the muscle, right? You can see that we broke over it on the morning session and we're unable to hold a higher low above. As a matter of fact, into the afternoon, you actually got a lower high underneath, leading me to believe that it wouldn't be unreasonable for some attempted gap close to the downside here if this level is going to produce something like a daily lower high, right? Daily lower high, unable to hold above, broke underneath, rejection offers you that lower high, highs, lower highs, daily inverted hammer, classic indication with a gap to close underneath. So that's the logic behind that one. Apple's a little bit more of a long contender if $200 can continue to hold. So if the market goes on to produce a breakout over the daily double bottom neckline, I'd be really interested in Apple doing a couple of things. If we can close the gap or support over 200, I would want to be long there. Or for a thin structure retracement over $206.50. Why? Here it is on the hourly time scale. You can see the thin structure from the liquidation break. This is the announcement of the tariff pause on electronics in particular, which of course hasn't stuck. But if we can Brigade bolt over the 206.50, that is where, with the help of the broad market also being bullish, I would really entertain long trades for something along these lines, risk reward in the upward direction. The pullback long would look something like this, maybe some overshoot or whatever. I would try the risk reward here. Back to the equal highs of 200 can hold, and then I would look to balloon runners through that same exact thin structure there. Ideally, in a picture perfect world, if everything works out, rainbows and butterflies, you would close the gap overhead, right? We would reevaluate at the daily 50, which is the blue moving average up here. Let's jump on into Nancy, Amazon. Amazon is looking more like a short on an overshoot, in my opinion, out of a balance range here. Look below and fail. target top end of the range, look above and fail, target the bottom end of the range. So a lot of it will have to do with the gap structure in here, but lower highs that persist underneath 183.50 are really interesting. So any consolidation that looks like this, I would call it hourly bear flag. Closing the gap into 176.75 is sort of the first idea to the downside, if not the full range rotation once again to 171.50. If it is going to be a long trade, I would be interested in a recovery here, and then like NVIDIA, the next step would have to be this higher low over 186.75 to trade into this equal high at 192.25. The 90-day pause high. GOOGL is not really in the cleanest of positions. I would say it's possible that a lower high emerges here and can persist up against 157 flat. Any closure of the gap might get interesting, but I don't... Maybe this is just me, and you tell me your opinion on Google in the comments section if you'd like, but I'm not really fond of trading Google in this range. I would prefer for it to do something a little bit more constructive like this, or just get underneath that 150.50 again for shorts to play to the downside through some of this weak structure from off to the left. The fact that we've balanced so firmly through this range leaves a little bit to be desired out of Google for me in particular. Metaverse, what do we see over here? A clean rejection of this threat. We talked about this on the Saturday update video. That 529.85 is the origin of the breakdown. It's the scene of the crime. So a lower high there makes a lot of sense. Any shorts up around that area got paid today, and I would continue watching for a rotation into the gap close, the high of the Tuesday session at 506.50. Reevaluate when you get there. If that is going to act as the neckline of inverted head and shoulders, it's also the bottom end of this previous range back here. That's the logical place where it might make sense for buyers to try to produce something like a daily higher low, a DHL shipment, as we used to say. Let's jump on into Tesla. Tesla. Tough after earnings. I mean, just a V-shaped recovery out of the open if you were watching this on the 5. Really funky stuff. Not even a full gap close. There's a little bit of unfilled gap down there. But if we just go back to the hourly time scale, there's a couple of things to make note of. Let's zoom out a little bit. If Tesla on the daily is going to get constructive, right, you got to get over this neckline for a double bottom. That's 286.85. Didn't happen, even with the announcement that Elon Musk was going to be spending less time working on Doge and more time going back to his true role as CEO of Tesla and all the other companies. So watching out for 260. If we can get over 260, it might give a decent enough trade from 260 to 274.50. There's plenty of range there to trade for. I'd be interested in this idea, risk reward here. Outside of that, you're still, again, this is like not a big long trade, but that's one of the upside intraday things that we can do. Other than that, just sideways action in this range is really unappetizing. I don't think that there's a big bold bet to make inside of this area. So 241 is going to act as your key downside level. If we take a look at JP Morgan, let's go to a daily so we can see the nasty inverted hammer. Look at that upper wick rejecting the daily 50. The only thing that's positive here is the fact that the bull flag broke out and a gap fill reversal keeps you over the flag at 236. If 236 can hold, well, just like the XLF chart, I would probably give financials a little bit more of the benefit of the doubt, which is helpful because it's the second heaviest weight sector for the S&P here. So looks like pullback could be imminent based on the upper wick rejection of the 50, but I would keep a very open mind to gap fill reversal at 236 or just in general sustained holds over 227.25 for the financial sector as a whole. As we move into Netflix to round it out, this is actually a beautiful chart on the hourly time scale. Look at this bull flag up here, bull pennant. It might be just, too obvious, too good to be true. But if Netflix, with all of its relative strength and might, can push into blue sky territories, boy, oh boy, does that get interesting in the upward direction. That would be over 1060. A really simple chart to watch here. It's technically a bullish 3-bar play on the daily time frame, right? You have this momentum bar to the upside, resting bar, break the equal highs, hourly Brigade bolt above the level, 1060. You're dealing with blue sky territory. So Netflix should probably remain a top watch into the end of the week. 2 trade ideas. Let's start with PLTR, which has been a fan favorite recently, and for good reason. Really solid setup, breaking out of the daily bull flag today. And honestly, I've got to admit, a little disappointed in my own execution, not following through. If you look at the 5-minute chart, this was just perfect. Check this out. As a 5-minute flag, it did move in the upward direction. I was a bit hesitant as the market, as anybody who saw the market this morning on a 5-minute time scale, right? As the market was doing this, I'm thinking to myself, I don't know if I want to make a directional commitment here until it gets out of the range, and by that time, PLTR had already gone. Anyways, going back to the chart, I think the follow-up here is on the hourly time scale. If we can get a pullback to set a higher low at 97.50, you might be like, well, that's a full retracement of today's session. That's fine. If we could set an hourly higher low and build out some sort of way to get involved off of this level, beautiful. I think the risk reward is still absolutely there to try working towards 107.75. So that's going to sustain itself as a top contender in the watch list outside of the core list. That's Palantir. And lastly, it's Coinbase. With the relative strength in Bitcoin, I think it's worth talking about this key level down here. The daily bar isn't all that great looking. It's a red doji, if you will, closing the gap, rejecting the daily 50. But if we just look at the hourly time scale, very similar to Palantir, even if a pullback unfolds, that's okay. Anything that sustains action over the neckline of this larger inverted head and shoulders at 182.50, I would be thinking about long side risk reward here, so long as Bitcoin maintains some of that relative strength. So that is what I've got for you in today's episode of the Midweek Market Update, a news-filled day. It is a jam-packed, news-filled day every day, it feels like, out of this market. We're trying to make heads and tails of it all. We're trying to remain very, very, acutely aware of our risk and our trade location in all of the things that we do. If you have not tuned into the pre-market prep, we're live every morning at 8 o'clock to try to make heads and tails of what we should be thinking about for the day's session. We've provided countless updates over on X this week as the markets are unfolding based on what the market internals dashboard is looking like. Is it a good idea to commit to longs? Is it a bad idea to commit to longs? Should we short the market? Should we long the market? What should we do? The market internals dashboard has lit the way, and it's really, more importantly than anything else, it's not even about nailing the upside trade or the rebound trade or whatever. It's about staying out of trouble when your thesis is maybe pointing one way, but the market is going the other way, right? You see something that's just screaming green on the upside, like Tuesday, for example, and it becomes very difficult to convince yourself you should short that market, even though on Monday you were saying, ooh, this breakdown probably should yield a lower high here. Well, you're not going to short the market for a lower high if the ticks are all over zero. You're not going to short the market when the breadth, if I just take a look at the ratio here on Tuesday, was up around double digits on the long side. You're not shorting that market. So if they don't get you into a long trade, or if they don't get you into the right trade, at least they prevent you from taking the wrong trade, which I think is really powerful. As we know, the name of the game in trading is to stay in the game, and that's all I've got for you in today's episode of the Midweek Market Update. Lots of stuff to cover. We'll continue to try to keep ourselves aware of at least what's happening in the news cycle, but I think bare bones technicals over 550, really compelling on the long side. If we're in this range, we're going to treat it as a range. And oh my goodness, nasty if we take out the equal lows down here. That's it. Hopefully you have a fantastic rest of your trading week. We'll see you up in the office bright and early tomorrow morning for our pre-market prep. Have a green trading week, and I will see you in the next one.